Today is Friday, the 13th, 2026. It's great to have your company. My name is Jessica Amir, a market strategist here with Moomoo. Well, some people, I guess, they rolled out of bed and they would have looked at their mobile phones or their trading screens, and they're seeing US major indices now underwater for the year. The Nasdaq 100 is down 2.2%. The S&P 500 is down ever so slightly. So why is that? Well, as Shirley Bassey saying, it's all a little bit of history repeating. The US market is unwinding expectations of US interest rate cuts. That's after we had a much stronger than expected jobs report, basically saying the US economy is doing well. You may not need an interest rate cut after all. And there's no expectation of a cut in June, maybe potentially a cut in July. So the market is adjusting to that. And what do we see when the market's adjusting? Well, fear. The VIX, which tracks fear and greed, volatility is now back at a level of 20. And surprise, surprise, that's why I'm saying a little bit of history repeating every time we see the VIX get back up to 20, Nasdaq 100 falls, and that's why it fell 2% overnight. So volatility is the name of the game this year. Obviously, that's going to be the case because we've got the US midterm election. Where to from here? Well, the Nasdaq 100 is only expected to gain 3% this year and maybe be just at 26,000 by year end. So that's a consideration. Meanwhile, Asian markets, they are charging in comparison to the US as well. They're seeing their best start to the year against the US in 100 years. Asian markets definitely like shooting stars. South Korea's benchmark index, the Kospi 200, that continues to extend its lead as the world's best stock market this year. South Korea's market, the Kospi, is up 35% this year. And that's fueled by gains. And of course, the AI build out. Their construction sector is up the most, 45%, while South Korea's IT sector is following. It's only up by 7%, but still it's phenomenal gains. And that's being fueled by chip makers and memory companies like SK Square, Samsung Electronics, up 55 and 49% respectively. As for other Asian markets that are shooting the lights out, you've got Japan's Nikkei continuing to do well. It's up by 15%. Year to date. What about Aussie's market? Well, the ASX 200 yesterday hit one of its highest levels in history, and our market is up almost 4% this year. Meanwhile, commodities overnight seeing a bit of profit taking, but the overall narrative is still strong. Gold is leading commodities. It's up 14% this year, but it lost 3% overnight as the market really unwinds rate cuts. Silver smacked down last night, losing 5%. It's only up 11% now this year. Volatility is absolutely freaking rife. That's the name of the game indeed. As to what's ahead next week, well, volatility could continue, or will markets move higher or lower? Well, there's so much going on in the US. The Fed meeting minutes are out. In earnings, we've got Palo Alto Networks, and I guess not traded as much though, but still quite important. DoorDash, Walmart, Live Nation. And down under in Australia, a huge week for commodity earnings. BHP, Rio Tinto, the heavyweights are reporting. In the lithium space, we've got Pilbara Minerals, and Pilbara Minerals is not only the lithium company reporting, but you've got MinRes. So MinRes is also in lithium, but also obviously in iron ore. As for gold, the world's biggest gold company, Newmont, that reports in the US, and equally they're listed in Australia as well. But what do you need to consider right now? Well, the market is giving you massive, huge, clear signals. They're in buy mode of who could potentially win and who is likely to win and who's going to potentially lose from that $3.5 trillion in spending on AI by hyperscalers and tier 2 cloud providers. Who's going to benefit from this $3.5 trillion freight train of spending right through to 2030? That's the focus of today. So we know the market is fiercely buying under-owned physical assets that will be needed to build out the AI network and that won't be replaced by AI. So there's many ways to I guess, string this bow. And here's a couple of considerations. So the first one is think about materials. We've been speaking about them a lot. Materials, miners, commodity names needed to build AI. So think about the companies that will be needed to build chip manufacturing in Asia and the US. Also think about mining companies in Australia. We've spoken a lot about mining companies in Australia delivering the strongest earnings growth that we're seeing across the world. We're seeing almost 200% earnings growth year on year. A couple standouts. South 32 is doing well. Obviously, the gold companies are also doing very well, but South 32, think about aluminium. And then the second bow to pull out is energy. Energy is doing particularly well. A couple of key subsectors in energy are doing very well that you need to consider. First of all, you've got the new energy names like uranium players, Deep Yellow, Paladin. They're doing well. They're up 30% this year. So the market is saying, hey, they're probably going to do well because we need a lot more AI build out. We need a lot more energy to keep it going. And then think about the old school energy companies. So think coal. So Yancoal and New Hope. It's probably been a long while for some of you since you've heard those names. Stocks are doing very well. They're up 20% this year. And then the other thing to consider is we spoke about what the world needs, physical build out, what's not going to be destructible by AI. Well, obviously staples. We all still need to eat. So Woolies stock is up by 10% this year. And I guess I just like the cartoon where you're thinking about Coyote running away. People need to think about what don't they need to run away from that a piano could fall on them, basically. That's I guess, one way to think about it. So investors are looking at the landscape. They're looking, how can I avoid that being crushed by a piano or a safe or whatever? What am I going to run towards? What's needed? What's essential? So we spoke about at the outset of this update, AI stocks doing particularly well. Asian benefactors are soaring, and those chip makers are doing really well. But then think about in the US, remember, Trump's administration said that, hey, we want to step out. We want to be the global leader. We want to be less dependent on Asian companies in the chip space. So with that lens, you really need to think about the fact that 80% of the world's AI accelerators right now are relying on two major companies. Obviously, Taiwan's TSMC, but we know Taiwan is probably going to win regardless because they are building out their own manufacturing there in conjunction with the US. And Trump loved making that announcement in conjunction with TSMC CEO. And then the other consideration is you need to think about South Korea's Samsung Electronics. So these two companies have got huge global market share. So then you need to think about the companies that Trump or the US administration will be tapping on, and the market needs to, I guess, consider and factor in where the most earnings growth, share price growth, and hot sauce could come from as the US tries to move away from their dependency on Asian producers. So the leaders, let's have a look at that. The market always tells you what stocks you need to pay attention to, and the leaders right now are clearly in flash memory. So why is that? Well, the outlook is the world clearly does not have enough storage to keep up with AI, and a big mover and shaker is NAND storage. So we spoke about this a little recently, but the type of NAND storage, just to rehash what we spoke about before, this is flash memory. It's basically used for long-term storage. And again, the narrative is that these companies are in short supply. So just to build this out, so think about NAND storage being long-term storage. It's needed in smartphones. It's needed in data centers as well. So you need to think about who are the players that are probably going to gain market share and who could potentially see more earnings upgrades and sky-high earnings. And this is what is going to keep stocks in this sector and subsector pushing to higher levels across the year. It doesn't mean we're not going to see huge swings of volatility that might be expected with some of the companies in this space. But the market right now is looking at earnings growth in some of these NAND companies of 100%. And that is why these shares are soaring. So a couple standouts in the US, Micron, which is the rival to SK in Korea. Micron's stock is up by 45% this year, Western Digital, also another large data storage company, and Seagate, another name. But these stocks are the three best performers in the NASDAQ 100 this year. They're up respectively 45 to 65% this year. And then don't forget about Intel. So stepping away from the NAND storage, think about Intel. In the NASDAQ 100, Intel is still doing really well. So this year, they've moved up almost 30% this year. And we know this is really because the US government, they're going into business with the fact that they're basically going into business with Intel, and they want to encourage companies, chip makers, to use Intel services. So Intel could win either way, regardless, and the market is telling you that. But overall, right now, the market is telling you where you need to move into. And don't forget that, as I've said, 100% earnings growth could be expected from some of these NAND chip makers, data storage companies, whatever you want to call them. But it doesn't mean that they're not going to see strong share price growth over the year. That's probably going to be the case. But I just would encourage you to think about maybe taking some profits off the table along the way, because volatility, as in big ups and downs, could be expected, particularly as we go into the midterm elections. So let's just cover specifically a couple stocks that you might want to add to your watch list now. Let's kick off with another large NAND storage stock, and that's Sandisk. Their stock has been continuing to do really well, up overnight 5%, up almost 160% this year, up $1,700 rather over the past 12 months. So just exceptional. But remember, in rising tides, all ships rise. Sandisk is, I guess you could argue, it's seeing one of the strongest gains in this subset of sectors and doing particularly well. Phenomenal share price growth, just being fueled again by that narrative that there is a lack of memory for small devices and also for data centers as well, because we need memory, of course, to run AI and to keep it going. The other thing that a lot of traders and investors really like is that Sandisk is, of course, have been a market leader for a long time, but because of their scale and their breadth and control of the market, they are quite large scale, and that enables them to keep their costs quite low. And that is why they're continuing to gain market share, and the market does like them. But if you think about what the market is telling us for what we could expect for Sandisk ahead, they're saying, hey, there's probably going to be more highs ahead if they can continue to gain market share in flash memory needed to build out data centers and other applications. So all in all, the expectation is that earnings growth could be almost 110% this year, earnings growth, and 64% the year after. So if you follow that narrative, the earnings growth drives share price growth, you could see a bumpy ride, perhaps over the next 2 years. But the market right now is telling you that their shares could grow 15% over the next 12 months. Again, going back to that narrative that there's not enough supply in this space. And the market is also telling us that this deficit could be around for at least 2 years. If you do look at what Bloomberg is saying, they're saying that the deficit could be around till at least 2030. All in all, the average analyst has got this stock as a strong buy. I encourage you to have a look at more information on Moomoo's platform. Let's move to Applovin now. Applovin stock is, well, investors are not loving that. Their shares down 20% overnight. We've been speaking a lot about a lot of momentum pressuring down software stocks, and this stock is definitely being embroiled on that. Even though Applovin did deliver far better than expected earnings and revenue, there were a lot of ticks. Some of those ticks exceptional. $1.7 billion in revenue, that's US. That was growth of 66% on the year. Strong forward guidance as well. So the market would ordinarily be very excited by hearing these type of things, seeing almost 1.8 billion US in revenue for the current quarter. So obviously the narrative is that revenue is growing and they see that continuing to grow. But this software name is down 50% from its September high. So all software stocks are being belted because investors are basically questioning, how is this company going to monetize apps? So that's what they do. The market is also fretting, with AI advancements, how are they going to, I guess, shore up their business model? How are they going to advertise and benefit companies that are in the advertising landscape? So there's no proof right now of a massive shakeup actually gripping revenue as we stand right now, but the market is looking for what's ahead. And this is exactly why the stock is going to be pressured, I think, from here on in. Doesn't mean it might not see a rally up, but the market is now looking at the lay of the land, seeing revenue growing at 44% this year. That's what the market is expecting us. And that's down from last year's growth. So a drop down in revenue growth. And the year after that, the market is expecting even less revenue growth. So I'm just painting a picture of a very slow, slippery dip. And that is exactly what the market is adjusting for, not just with Applovin, but other software companies. There's going to be a drop in revenue growth. So you need to think about that. But this company itself, Applovin, has also been, I guess, embroiled in a few other issues, if you want to call it that. There's been some short seller things going on, and there's an SEC inquiry as well. But still, given that the stock is down 50% from its highs, its valuation might look cheap. So on the Moomoo platform, if you do have a look at what the average analyst is saying, they're saying it's a strong buy. And the expectation is, among all the analysts that cover the stock, that it could potentially gain 80% in the year ahead and hit $660. Last night it closed at $366. So who knows what's going to happen with this one, but I don't know. Take a look at it. Meanwhile, let's have a look at ANZ Bank. ANZ, like all banks, are surging. ANZ doing really well yesterday, up almost 9%. It pumped up 8.5%, hitting a brand new record all-time high. For technical people out there, you would have seen its shares gapped higher, which means it could go higher again. Now, the entire Aussie banking sector as well did really well yesterday, rising 4%. But the market loved hearing what ANZ announced yesterday, including the CEO's plan to boost profits on the back of slashing costs and overhauling their business. They've done that for the past year. So they've retrenched thousands of staff, and that enabled them to report cash profit of $1.9 billion for the quarter. And they dropped costs by, I just had to double check this, they dropped costs by 21%. That's just outstanding. So they are making good progress also with integrating Suncorp Bank. So well done. And they kept their guidance in place for the year ahead. So the market loves hearing this stuff, obviously. No one likes bad surprises, but they love good surprises, and they love when they open up a present and it's exactly what they expected. And that was the case for ANZ. So you could argue that it was better than expected news. Yes, it was. And that's why you get upgrades to the stock. So a couple of big standouts overnight. Morgan Stanley lifted their price target for ANZ by 14%. They now expect ANZ to be 41.30, but don't get too excited by that. Yes, they do have an overweight rating, but yesterday ANZ closed at $40.35. But the narrative is that they don't have that much to go in terms of their share price gain. If you have a look at the lay of the land, the average investment analyst has got the stock as a hold, not really thinking there's going to be that much lift to its shares ahead. Nevertheless, the tide has shifted, and we're seeing a lot more upgrades overnight. Not just by the heavyweight Morgan Stanley, but other heavyweights like Goldman Sachs and Citi have reiterated their buys for ANZ. So who knows?